Hello, this is Charles Zhang, founder and president of Zhang Financial. Welcome back to our podcast. At last week's Fed meeting, the Fed has abandoned the option of soft landing. The Fed Chairman Powell reiterated his determination in continuing to raise interest rates and keep them at those high levels until the inflationary pressure subsides. Historically, when the Fed aggressively raises rates, the economic growth slows or contracts. As we discussed last week, this year will go down as one of the worst years for bonds in the history of the aggregate bond index. We have received some questions about prospect of fixed income. With the Fed committed to fighting continuing inflationary pressure, even at the expense of economic contraction, we think investment-grade bonds have the opportunity to act as defensive role against and hedge out risk for equities within a diversified asset allocation portfolio. Next, our investment strategist Rob McDougall will give you more insights of recent economics updates, and also hope you will join us for our client event. We already have over 300 people assigned for our client events in Kalamazoo. Thank you. See you soon.
Happy Monday, everyone. This is Rob McDougall from Zhang Financial with your weekly economic update. Today is September 26th and Monday. As always, we're going to go through economic data that was released last week, talk about how the markets responded to it, and then take a look at the economic data points that are going to be released this week. So in terms of last week, there were 3 housing-related metrics that were released. And most importantly, the Federal Open Market Committee decision, which occurred on Wednesday. But first, we'll go through the housing numbers. They were mixed last week, but I would say it's slightly positive. So 2 out of the 3 metrics beat expectations, 1 below. Housing starts actually surprised to the upside with a surge up to nearly 1.6 million, well above the consensus expectations of 1.4 million. So that was positive. Building permits, however, which is at the beginning of the cycle, was definitely negative. So expectations were building permits of 1.6 million. For the month of August, it came in just above 1.5 million. So the other offsetting and positive metric in terms of housing was existing home sales, slightly better than expected. Expectations were 4.73 million. For the month of August, it came in at 4.8 million. Now, in terms of the FOMC rate decision, that was clearly the big news of the week/month. The FOMC on Wednesday announced another increase to the Fed funds rate, another 75 basis points, taking that up to the range to 3 to 3.25%. So in total this year, 300 basis points of increases from the Federal Reserve. On top of that, during the discussion, the Federal Reserve was clearly very hawkish on this call and suggested by the end of the year we should expect another 125 basis points of increase and to expect at least one more increase in 2023. And probably the most disappointing part of the discussion was not to expect any rate decreases in 2023. So, as you might imagine, the markets did not respond well to this information. Equities were down, international equities down, fixed income down, everything down again for the week. What really moved were interest rates, of course. The 2-year yield increased last week by 36 basis points, finishing Friday at 4.21%. The 10-year was up 25 basis points. That finished the week at 3.7%, but hit 3.84 during the week. So in terms of how the equity markets performed, S&P 500 was down 4.63% last week. Underneath that, value held up a little bit better, but not great. So growth last week was a negative 6.3%. Value was a negative 4.9%. So on a year-to-date basis, again, values held up much better. Values down a little less than 11% for the year. Growth in the U.S. down nearly 36%. Again, last week, equities down across the complex, including international. So I mentioned the S&P 500 was down 4.6% roughly last week. The rest of the world was down 5.75%. On the fixed income side, as I mentioned, the 2-year and the 10-year rose dramatically last week. So the Bloomberg U.S. Aggregate Bond Index last week was down 1.56%. Now that was for the week. Year to date, that index is down 13.75%. So nothing positive there. In terms of upcoming economic calendar for this week, tomorrow, Tuesday, we have the U.S. Consumer Confidence number. Now, that's expected to tick up. This is the Conference Board number, not the University of Michigan. The University of Michigan Consumer Sentiment Index, released a couple of weeks ago, was positive. Expectation for U.S. Consumer Confidence Index is for that to move up slightly as well. It was 103.2 in August. The expectation for September is going to rise to 104.7. Friday is the big day this week in terms of economic data. We get both personal income and personal spending, see how the consumer's doing. In both cases, the expectation for August, both will be up 0.2%. Probably more importantly on Friday, inflation news. The government, Federal Reserve, prefers to use the PCE, the Personal Consumption Expenditure Index versus the CPI, so it's critical to watch this. The PCE is expected to drop slightly in the month of August from 6.3% in July down to 6.2%. Core PCE, however, that's ex-food and energy, is actually supposed to or is expected to rise just slightly, a small uptick from 4.6% to 4.7% in August. The Federal Reserve has conditioned us, based on the Wednesday meeting, to expect inflation to come down pretty significantly given the interest rate hikes taking effect over the next 6 to 9 months. In fact, the Federal Reserve on Wednesday set expectations for PCE, which again right now is running at 6.2%, to drop an average 2.8% during 2023. Likewise, PCE core, again, ex-food and energy, currently running at 4.6%, is expected to drop to 3.1% for all of 2023. So based on that, the GDP estimates are now coming down for the third quarter. Again, the Atlanta Federal Reserve, for the third week in a row, dropped their expectations. Just a month ago, they expected third quarter real GDP growth of 2.6%. They've continued to drop. Last week, they dropped that barely above even to a positive 0.3%. And the blue chip consensus economist forecast actually dipped slightly negative last week. So the expectation by economists is we will have our third consecutive real GDP growth, negative GDP growth quarter in a row. Last thing is inflation expectations, again with the Federal Reserve increasing interest rates and their expectations for inflation to come down. Inflation expectations in the market have dropped. So now the 10-year break even, which we often cite, that's the 10-year Treasury minus the 10-year tips, dropped down to 2.37%, near the low that we hit in July earlier this year, well down from last week and from a month ago. So that is it in terms of the economic update. I'd just like to remind you all we do have Zhang Financial client events coming up. On Wednesday, we'll have a lunch and a dinner, separate lunch and dinner here in Portage. In Detroit, we have a dinner scheduled on the 19th of October. We may be opening up a lunch as well. And in Ada, we have a dinner on the October 26th. And lastly, we'll finish on October 27th with a Zoom presentation with the same material. Thank you very much for joining us. We look forward to seeing you next week.